Yeah, so welcome back friends. So in this session, I will be discussing more about the monetary policy. I will be discussing expansionary versus the contractionary monetary policy, monetary transmission, impacts of the monetary policy, limitations of the monetary policy, and a very important term, that is liquidity trap. We will discuss everything, and most of these terms are regularly in use. The country is facing a problem where the inflation rate is increasing and the demand is falling, right? So this contradiction happens, and in the long term this leads to the stagflation. So we will discuss all of these. So starting with the two types of monetary policy. Friends, what is the basic objective of monetary policy? So as per the amendment which was done in the RBI Act in the year of 2016, the main objective of monetary policy is to maintain the price stability. To maintain the price stability means there are two possible situations. Either we have inflation or we have the opposite situation, that is deflation, right? So if we have inflation, that means we need to reduce the money supply. We need to reduce the money supply. That means we need to contract the money supply, or we need to tight the monetary supply, right? So the tools which are used at this time, the changes in the different tools which is done to achieve this contraction or tightness is called the contractionary or tight monetary policy, right? And in the opposite case, when there is deflation, that means money supply needs to be increased. We have to increase the money supply. So for increasing the money supply, we have to expand the money supply, and all the tools which are used, the changes which are done in the tools, those changes are called expansionary monetary policy, right? So these are the two kinds of the monetary policy. Now we will discuss in detail. So first, expansionary monetary policy. So when central bank lowers the interest rate so that more borrowing can happen and savings can be discouraged, right? So that will actually increase the demand and it will lead to the growth. So how does that happen? So when in the expansionary monetary policy, let us see. In the expansionary monetary, first of all, when is this used? This is used at the time of recession or when there is a condition of deflation. So at this time, what we do, we will buy the central bank will buy the government security. That means it will flush out the rupees in the market, right? So it will buy the government security and in return it will give rupees to the market. Lowering of the bank rate, that means interest rate will come down into the market. Reduction in the CRR, that means more money is available for the bank to give as a loan. So again, it will lead to reduction in the interest rate. So the combined effect of all these changes is increase in the money supply. If there is increase in the money supply, interest rate falls, and if interest rate falls, the businessmen are ready to make more investment because their cost of investment is decreasing. So the investment increases, and the households, the normal consumer, they also start buying more amount of goods because the money is available at a less cost. So aggregate demand also increases, right? So demand also increases, and when the demand increases, the output of the factories also increase, because when there is demand, then there will be price rise. When there is price rise, the businessmen have incentive to produce more, because the businessman is expecting that he or she will get more profit in the future from the sale of same product. So it leads to aggregate output increase, and that means GDP growth, right? And it has a positive impact over the employment level, because when output is increasing, production is increasing, the jobs will also grow. So it has a positive impact upon the employment also. So that has a very, very prosper, the virtuous cycle basically. Next is contractionary or tight monetary policy. Contractionary or tight monetary policy, that means when the central bank increase the interest rate, and this will be done at the time of high inflation or when the aggregate demand needs to be decreased. So what will be done? So it will be done at the time of inflation. What will be done? The central bank will sell the securities, a bank rate will be increased, the CRR will be increased. So the combined effect of this will be the money supply will decrease, interest rate will increase, and investment will decline, because when the interest rate increases, the businessman will not be interested in establishing more factories, because the cost of investment is increasing and profit is decreasing. The normal consumer like you and me, we will also be demanding less goods. We will be postponing our purchasing behavior because the cost of buying is very, very high. So price level will fall. When the price level falls, then this inflation comes under the control, right? So in the expansionary monetary policy, there is increase in the total supply of money rapidly than the usual. In the contractionary, expands the money supply more slowly than usual or even shrinks it. Okay, so expansion is happening, but it is slow, right? Or it can be even shrink. Even the money supply can shrink below the current level, or the growth will be not at the up to the high level, right? Now consider a situation of deflation. So in the deflation, there will be the remedy is expansion. That means reduction in the interest rate, and in the open market operation, the RBI will be buying the bond in the open market. So I am repeating the same thing again and again in different slides, so that you have very strong grasp over the concept. You can see the concept from the different perspective. When there is inflation, that means contraction has to be done, interest rate have to be increased, and the bonds can be sold in the open market for this. Now, this is very, very important. Monetary policy transmission, or this is also called as the monetary transmission. So we have been saying that changes in the repo rate or the policy rate have a direct impact upon the money supply in the market. So if RBI increases the repo rate, that means the people like you and me, we should be directly impacted. Our interest rate, the interest cost should also be increasing. So that is the logic that we have already discussed. Theoretically, this is very, very valid. Directly we can discuss. There is no doubt about it. However, in practice, this does not happen. I'm repeating. So in practice, even if the repo rate is coming down, still the interest rate for the common consumer, it does not come down, right? Or even if it comes down after a long period of time. So if today is the 1st January 2020, RBI reduces the interest rate by 1%, it reduces the repo rate by 1%, the consumer like you and me, we will be seeing the impact after 3 or 4 months. So our loan interest rate will be decreased after 3 or 4 months. So this is called time lag. The transmission of interest rate changes from the central bank to the consumer. This is one thing, right? So there is a time lag. Secondly, the quantum of change is not transmitted completely. So if RBI is decreasing repo rate by 1%, you or me, we will be getting the impact of maybe up to only 0.2%. Only 20% impact we will be having. So why does that happen? What are the different factors? What RBI has been doing? What more can be done? So we will discuss everything under this system. So monetary policy transmission. What is monetary policy transmission? It is a process, right? So it is a process through which the policy action of the central bank is transmitted with the ultimate objective of stable inflation and the growth, right? So policy action means changes in the repo rate. This is the main policy. This is the main policy action, right? So changes in the repo rate, they are transmitted. They are having a direct impact upon the inflation and the growth. So this transmission hinges crucially on how the monetary policy changes influence households and firms' behavior. And this change can happen because of different channels. So what are the different factors which impact the monetary transmission? What are the different factors which decide that how much will be the impact of change in the repo rate over the consumer? So first is the interest rate, right? So first is the interest rate. So the money that you and me are getting from the bank as a loan. So when we go to the bank gives us a loan. The money that we get as a loan, that money is not the source of that money is not only from the RBI. So it is not that the bank has taken all the money from the RBI and given us to the loan, given as a loan. Bank may have multiple sources of money. The customers are depositing their money. Bank can raise from the capital market. It can raise from the money market instrument. It can take the borrowing from the RBI. So there are multiple sources from where the money is coming to the bank, and bank is given us as the loan. Now, out of these multiple sources, the borrowing from the RBI, the borrowing based upon the repo rate is just one channel. It is not that all the, it is one among the multiple channels, right? So when there is a change in the repo rate, there is a very small impact upon the total cost of the fund for the bank. Are you getting? So because of the multiplicity of the sources which from where the banks can raise the money, this change in the repo rate do not have the direct impact upon the consumer. So this is the first thing. Second, financial inclusion. This is also very crucial. So we don't have the bank branches in the rural areas. Even if we have the bank branches, but still they are not accessible. They don't have the internet banking. They do not have the electricity. So the financial infrastructure is very poor. So even if the repo rate is changed in the Mumbai by the RBI, but will it reach to a remote village in the Bihar, in the Uttar Pradesh, in the Madhya Pradesh? That cannot be as ensured. That cannot be ensured. So this financial inclusion also is one of the factor. Next is the balance sheet of the bank. That means whether the banks are having good strength and the willingness to give the loans, or banks are suffering from the NPA. So presently banks are suffering from the NPAs. So when the banks are already suffering from the NPA, they would avoid giving more amount of loan. And if they don't give the loan, then forget about change in the interest rate. So even if there is a change in the repo rate by the RBI, still the common man do not get the benefit. Asset prices. So assets like property like land, building, plant and machinery. So these assets are actually given as the collateral to the bank by the customer, right? So when in the market there is an inflation, that means the value of the collateral will increase, and when value of the collateral will increase, the bank will give the more loan, and vice versa. So if in general there is a slowdown, which is the case right now, the prices of the property will go down. When the prices of the property will go down, value of the collateral will go down, then bank will not be giving much loan to the customer. right? So when bank cannot give the loan because the value of the collateral is decreasing, then even if the RBI is changing the repo rate, it will not matter for the customer, right? So these asset prices, general economic condition also matter. Next is the competition, right? So 30 years ago, major source of savings were the bank, but now we have multiple sources. We have mutual funds, we have stock markets, and many more opportunities. And the good thing is that middle class is becoming financially literate. The risk appetite of the people is increasing. The people are interested in taking more risk, especially the young people like you and me. So because of all these factors, bank is not the only place where the customer will like to deposit the money. There are many competitive places available. So it becomes a challenge for the bank. So bank, in order to attract the customers, to avoid loss of the client, the bank will like to give the interest, the high deposit rate and the less lending rate. So irrespective of what change are happening in the monetary transmission, the bank has to maintain its client, and for maintaining the client, it has to face the competition, and this competition actually is one of the factor for deciding how much will be the monetary transmission. So these are multiple factors because of which monetary transmission is not directly happening even if the RBI is changing the repo rate, right? Now, importance of the monetary transmission. So monetary transmission is important because after the RBI Act was amended in 2016, the primary objective of the monetary policy became price stability, and the Monetary Policy Committee came up with the inflation targeting framework, where the flexible target has been given worth 4% plus minus 2% of CPI. So this has become the nominal anchor. So RBI has to maintain the inflation rate between the range of 2% and 6%. This Monetary Policy Committee will have the decision making power regarding this, right? So if inflation rate has to be maintained between 2% and 6%, then monetary policy has to work. The supply of money has to be controlled, and that control can happen only if the good transmission happens, the good monetary transmission happens. Now, if we see, as per one of the recent RBI report, there is a time lag in the transmission. So during 2001 to 2011, this time lag was 7 months. So if RBI changes the repo rate on January 1, 2020, this will impact the consumer like you and me in the month of July 2020, right? But now, because of the different reforms, this transmission is now taking just 3 to 4 months. So this is a good news. Still, this 3 to 4 months is not a short period of time. This is also not a short period of time. Ideally, it should be only few weeks. Now, what are the reasons behind weak transmission in India? First, rigidity in the saving deposit interest rate. So, this saving deposit, the saving deposits are actually done by the customer with the bank. And if we see the current pattern, more than 80% of the saving deposit are for the long term. They are term deposit, and because with their term deposit, the interest rate is fixed for the term deposit, right? So we cannot change the interest rate for 80% of the deposit. We cannot change for the 80% of the deposit, and rest of the demand deposit, 20%. Even in that case, we are having the challenge of having the competition from the other financial saving instruments, right? Next is deterioration in the health of the banking sector. So we have been facing the NPA crisis. That is also one of the very big aspect. The NPA rate have crossed 2 digits multiple times, right? Poor financial inclusion, this remains a big challenge. So because of these challenges, the transmission remains weak. And this article, which you can see, this appeared in the Indian Express, why interest rates are not falling. So RBI has been decreasing the repo rate for a long period of time, but still why the interest rates are not decreasing for the people like you and me. So what is the reason? So apart from these reasons which we have just discussed, one of the important reason is this rigidity in the saving deposit interest rate, right? So one thing that I already told you, that 80% of them are the term deposit, right? And now next is lending rate. Why lending rate is not changed? So what is lending rate? Lending rate means the rate of interest at which bank gives loan to its customers. So why the lending rate is not changed? So the lending rate is not changed because bank borrows very less, just 0.25% of their deposit from the RBI at the repo rate. So as I told you, bank have multiple sources of getting the money. So even if RBI reduces the repo rate, bank's cost of funds, the rate at which it offers to the depositors, does not come down, and hence it is not willing to reduce the lending rate, right? Some funds which the banks borrow from money market and the capital market as that may come down slightly due to reduction in the repo rate, but the volume of money raised from these markets is also less than 20%, hence it does not impact much the lending rate of bank, right? So can you see that even if RBI reduces the repo rate, is still the bank cost of fund is not going to come down, because the source of money from where the bank is getting the money are multiple, and the source which belongs to RBI is very, very minuscule. Impact of external benchmark rate based lending rates, right? So since October 1, 2019, in India, we have adopted this external benchmark rate based lending rate for selected sectors, right? So for the sectors like retail and the MSME loan, the banks are under compulsion to link it with the repo rate, right? So for example, we talk about the home loan. So home loan is part of the retail loan only. So home loan will be given, for example, at the repo rate plus 3%. For example, repo rate is 5.15%. So 3% will be added by the bank as the extra charges, which is also called as the spread, and the customer can get the home loan at the 8.15%. So the lending rate have been directly linked with the repo rate. So the 3% is the spread. This 3% is the spread, which will include the bank's profit margin, costs, credit risk, like the risk of non-recovery of the loan, and for operational cost also, right? Now this 3% is very, very high. This 3% is very, very high. So effectively, even the previous reductions have not been transmitted because of this high 3%, right? So the banks can revise the spread also, and in that case again lending rate may not come down. So even this spread is not fixed at 3%. Even the bank can increase the spread, and when the bank increase the spread, then the lending rate will not come down. So the point I want to make is that even the external benchmark rate based lending rate will not make much difference, because it has the element of spread. It has the element of spread which the banks can change, and this spread is very, very high. So what will be the best mechanism? The best mechanism is to link the deposit and lending both with the repo rate, right? In that case, when RBI will change the repo rate, the bank deposit rate, that is the cost of fund, will also come down, and the lending rate, that is the income, will also come down. Now, what are the other efforts done by the RBI? Other efforts include insolvency and bankruptcy code. So it will revive the banking sector by resolving the problem of NPA crisis. So when banks' balance sheet are good, they can give more loan. The transmission can happen easily. NBFC regulations, even the NBFC is under the government supervision. prompt corrective action framework. So for those banks who are having the high level of NPA, this PCA framework is working so that their health do not deteriorate further. Asset resolution, so resolution of the NPA, and bank recapitalization, giving more capital to the banks, bank recapitalization. So because through all these measures, the government is trying to strengthen the monetary transmission in India. Now there are more suggestions, what more can be done. So these suggestions I have taken from multiple articles, and this has actually become a kind of mains question. So there is a possibility that in the mains examination they can ask this question, that why the monetary transmission is not happening, what are the efforts of the RBI, and what are the different suggestions which you want to give. So what are the suggestions? First suggestion is the surplus liquidity, right? So we should have the surplus liquidity. When the liquidity is surplus, the banks are ready to give the loan, and when they give the loan, they can have the impact of the repo rate. Then lending rate should be market driven, which we have already done for some of the loans. Stable financial system, and in the last, linking the deposit and the lending both with the repo rate, as we just discussed in the previous session. How does the monetary policy affect the different sectors of economy? First, lending rates. Lending rates are directly impacted, right? So if repo rate is increased, the lending rate is also increased, and the impact of lending rate increase is that the business investment comes down. Exchange rate is also impacted, because if we have the expansionary, if we have the extra money supply, if the money supply is high, that means the rupee supply is high, that means the rupee's value will come down, right? So rupee value will come down. Effect on the employment. So if there is high deflation, then we will try to use the expansionary monetary policy, and when the expansionary monetary policy is used, then unemployment can be reduced. GDP growth rate, that is also impacted, because change in the money supply actually changes the investment decision, and change in the investment decision impacts the GDP, and GDP changes actually impact the growth rate. So you can see direct linkage between the different things. Now, limitations of the monetary policy, most of them we have already seen, that first, there is a time lag, right? Time lag in the implementation and the working. So because of the time lag, if the time lag is so long, the policy may become ineffective. So if the prices are too high today and we reduce the repo rate today, then it will take maybe 3-4 months. So in this 3-4 months, there will be nothing. There will be no impact upon the consumer. So it will have an adverse impact. Problem in forecasting. So even the effect of monetary actions, they may not be forecasted. The data is not easy. The collection of data is not easy in India. We already have so much issues going around the data. NBFC. So there are huge operations which are done by the institutions other than the bank. So their operations also impact the monetary policy. Underdevelopment of the money and the capital market. So money and the capital market are fragmented, they are unorganized, and they work independently. So we have a lot of unorganized banking structures, informal lending structures. So because of that, the monetary policy will not impact everyone. Only that person who gets the loan from the bank will be impacted, and those people who get the loan from the lender, they will not be impacted. What are the other limitations of the monetary policy? So in case of deflation, so when there is low money supply, RBI will increase the money supply. How it will increase? By reducing the repo rate. But in any case, this repo rate can not be below zero. It cannot be less than 0. So there can be a situation where even if the repo rate is 0, still this deflation condition is not going away. So here the monetary policy becomes ineffective. Next is stagflation. Stagflation is a combination of two words, stagnation plus inflation, right? So stagnation means there is no demand, still the prices are high. So this is a very contradictory situation. Normally the prices are high only if the demand is high, but here there is no demand, still the prices are high, right? So in this case we have the inflation, and for countering the inflation the RBI will reduce the money supply, right? But reduction in the money supply will be having no impact upon the demand. The demand will not be impacted. Why? Because the demand already, there is no demand. So even if the money supply is reduced, still there is no impact upon the demand. Demand cannot be negative, right? So there will be no impact upon the demand. So in this case, even the monetary policy fails. Even in this case, the monetary policy fails. So in this case, what is the solution? The solution is basically to work upon the supply side measures, that is doing more investment, right? So that more and more production can take place and this price can come down, right? So that more production can take place and this price can come down. And apart from this, there can be other solution also. For example, controlling the exchange rate, because at times the high exchange rate, the negative exchange rate also impacts. So there can be a situation where because of the high crude oil prices import, the prices are rising, right? So there is no demand, but still the prices are rising because the cost of import is very, very high. So we can take the effort to resolve that also, right? So in this case, in case of stagflation, the monetary policy fails, right? And at present, we are moving towards the stagflation. The economists are discussing whether we are in the stagflation or we are moving towards the stagflation. So this becomes very, very crucial for your examination also. Now, next is liquidity trap. So monetary policy is also not effective when there is a liquidity trap. Before I discuss this term of liquidity trap, let me tell you that relationship between interest rate and bond prices, right? So this relationship between the interest rate and the bond prices is inverse. Relationship between the interest rate and the bond prices is inverse. That means if the interest rate increase, the bond prices will come down. If the interest rate decrease, the bond prices will go up. This is the one thing that you need to understand. Now, what is liquidity trap? So there is a situation when there are high savings with the customers or with the citizens. So the level of savings are very, very high. That means they are having the balances in their bank account, right? In the bank, they are having the balances in their bank account, and in the market there are a lot of bonds available for the sale. So these bonds are basically investment opportunities. Now suppose Mr. A is having money in the saving account. So Mr. A is not buying the bond. Why Mr. A is not buying the bond? Because Mr. A is expecting that at present the interest rate are low, right? So this is also one of the condition. So there are low interest rate and high saving. These are the two conditions, right? So this low interest rate is also the condition, right? So there are high savings and low interest rate. So Mr. A is saying that because the interest rate is already very low. In the future, the interest rate is going to increase. And when the interest rate increases, the prices of bond will come down, right? So assuming that buying the bond will not be beneficial, because in the future the interest rate will increase, and as the interest rate increase, the prices of bond will come down. If the prices of bond come down, then he or she will lose in the investment. Are you getting the point? So because of this psychological issue, they are not buying the bonds. So even if there is huge balances in the saving account, interest rate are low, there are investment opportunities, still people are not ready to invest into the economy, and the liquidity gets trapped into the bank accounts. Are you getting the point? The liquidity gets trapped into the bank account. That is why this is called liquidity trap. This is very, very important, because this concept has been given in the NCERT, and till date this concept has not been asked in the examination. There are high chances that examiner will ask this question, right? So a liquidity trap is a situation in which interest rates are low and saving rates are high, rendering the monetary policy ineffective. In liquidity trap, consumers choose to avoid the bonds and keep their funds in savings because of the prevailing belief. So this is a belief that interest rate will soon rise. Because bond price have an inverse relationship, so consumers may not want to hold the asset with a price that is expected to decline. So a liquidity trap is when monetary policy becomes ineffective. It is a function of economic conditions and also psychological. And it is not limited to bonds only. It can impact the demand of the products also. What is the solution? The solution is increase the interest rate. Definitely it has to be increased. And when the prices fall further, when the prices of the bond fall further, there will be a point where the investor or the Mr. A will like to buy it, right? And also increase the government spending. So in the liquidity trap, there is a absolute liquidity preference, and low rate of interest, people will hold money as the inactive balance. However, demand of money does not depend so much upon the current rate of interest. So the current low rate of interest is not actually impacting the demand, but the expectation or the psychology is impacting the demand. In 2013, there was a question, supply of money remaining the same when there is an increase in the demand of money, right? So supply is same and demand is increasing. That means there will be increase in the rate of interest. This is the solution. With this, I complete this session. Thank you very much. God bless you.